Accredited investors. If you're raising capital for multifamily real estate, this is a must know. Who are accredited investors? Why is there a definition in the first place? And why raise capital from accredited investors? This is what we're talking about in this video. So make sure you hit the subscribe button right now so you don't miss more videos about building wealth through multifamily real estate. And if you don't know me, I'm Seth Ferguson, a 12-year real estate veteran, host of a real estate TV show, host of a real estate investing podcast, and I'm also the author of the real estate book, Sell for More. So let's get right into it and talk about accredited investors, what you need to know. Well, first, let's start off with the definition of an accredited investor. And there's a couple different thresholds or criteria that we can use to determine whether or not a potential investor is accredited. Well, first of all, we can go by income. So the income threshold that they have to hit is $200,000 a year on their own, or as a couple, $300,000. And they have to have a reasonable expectation of hitting the same income levels again in the future. The second test is assets. If an investor has $1 million or more of net assets, they can be identified as an accredited investor. Now, this does not include your primary residence. So let's say an investor has a primary residence worth $1 million and it's mortgage free. They cannot use that to qualify as an accredited investor. So it has to be net assets minus their primary residence. So you can either use income or assets. So some people may qualify based on their income. Other people may qualify as their assets. This begs the question, why do we have an accredited investor definition in the first place? Doesn't it seem arbitrary that somebody earning $190,000 a year doesn't qualify, but somebody who earns $200,000 a year does? Well, I totally agree with you. It doesn't really make sense, but this is the way it is. The reason this came about is that the government decided in their infinite wisdom that somebody who earns this type of income or has this amount of assets is better able to absorb potential losses they may incur over the course of the investment. They are also able to afford better counsel, so they are able to go out and seek expert advice from lawyers and accountants and other professionals, so they are able to make better decisions when it comes to whether or not they should invest in a specific opportunity. And this all started back in the day when these swindlers used to go travel from town to town, swindle people out of their life savings with the promises of quick riches. And these people had no recourse and they had nothing left. They invested all their life savings into these scumbags and they ended up with nothing left. So the government stepped in and said, listen, you have to hit these certain thresholds to be able to qualify for these certain types of securities, these investments, because you're going to be better able to absorb the losses and make better educated decisions. Now, is this the case? No, I know lots of people who are very qualified to invest in very sophisticated real estate deals, but they don't meet the criteria of either income or assets. Then I also know other people who definitely do meet the criteria, but they know nothing about investing in real estate because they have made their money. They are experts in other areas. Is the criteria fair? No. Is life fair? No, we just have to deal with it. So if you are raising capital, you just have to be aware of, you can either qualify using your income or net assets. The question is, why raise capital from accredited investors? And there's many different reasons. I just want to highlight a couple here. So number one, they have more money. they produce more income. They have more disposable income. They have more assets. So they are able to invest more into your deal if it is a good deal. Number two, they have access to accountants and lawyers to give them good counsel. They are able to make better educated decisions on your investment, and that's what you want. You want somebody investing in your deal that is educated, that is looking at all possibilities. You don't want somebody who's just going on your word. Even though we all want to be trustworthy in everything we do, you want somebody to do their own due diligence and make wise decisions with good advice. So that they have their team built around them and they're in a better position to make better investments. Number three, let's talk about some structures for a second. So we have 506B and 506C. These are the types of securities offerings that we are able to offer to investors. 506B is where you can only offer that opportunity, that security, to accredited investors only, and you can't advertise it. And this is why it's commonly said that the general public doesn't know about the best real estate investment deals out there. And it's true, because if I'm offering a 506B, I can't advertise it. I have to take that opportunity to accredited investors only that I have a previous relationship with. So I can't put up billboards, I can't run ads on anything. I have to work my own network of accredited investors and bring them that opportunity. The public never even knows about it. The public doesn't know it exists. And this is why it's very true that the best real estate investment opportunities are not general public knowledge. The general public doesn't even know they exist. So that's 506B. 506C is where you can start advertising your opportunity. You can bring in non-accredited investors, but there's a whole lot more red tape and more onus placed on the syndicator, the person with the offering. And I don't know about you, but most people like to avoid red tape. And if we're looking at this from a bookkeeping, management, customer service point of view, I would rather have less investors in a deal, but bringing more capital, so the accredited investors, rather than more non-accredited investors bringing a smaller chunk, because it's easier to manage, less people, keep them up to date, have that personal touch, you give them regular updates and answer any questions. I would rather work with, let's say, 25 investors rather than 125. It just makes life so much easier. This video is much too short to talk about the differences between a 506B and a 506C offering. But the main thing to keep in mind is that the onus, the red tape, all the work you have to do to verify all that stuff is much less with 506B, because you're not advertising it and you're only working with accredited investors. So when we're talking about raising capital from accredited investors, well, we know they have to either hit the income threshold or the net asset threshold. We now know why the government set up this arbitrary number, because it's to keep people safe and making sure they're able to make good investing decisions. And then we briefly talked about 506B, 506C, and why we want to raise capital from accredited investors. Well, they have the money, they're able to make better investing decisions, and we can bring less investors into a deal, and that makes everybody's life a whole lot simpler, and the investors will be much happier down the road. If you're interested in learning more about the deals I'm currently looking at, head on over to callseth.com and set up a free 20-minute phone call with me. And if you like this video, if you found this useful, hit the like button, leave a comment, let me know what you think, and until next time, happy investing.